The most common reason people are rejected for a mortgage is not a low credit score, but a debt-to-income ratio that is simply too high for the bank's comfort. If your monthly debt payments consume more than 43% of your gross income, most lenders will view you as a higher-risk borrower and deny your application. The fastest way to drop your ratio is to pay off small balance installment loans entirely, because eliminating a $300 car payment is more effective than paying down a large credit card. You should avoid taking on any new debt or financing large purchases like furniture or vehicles while you are in the middle of the home buying process. Requesting a credit limit increase on your existing cards can sometimes lower your required minimum payment, which instantly improves your qualifying ratio. If you have high interest debt, you can consolidate those payments into a single, lower interest personal loan to reduce your total monthly outgoings. Adding a non-occupying cosigner with a strong income and zero debt can also balance out your ratio and help you qualify for a much larger loan amount. Visit homebuyingrealty.com to download our DTI Emergency Repair Guide and see exactly which debts you should pay off first to get your mortgage approved.